Chapter 13, we cover financial statement analysis. And there's different ways to analyze the financial statements. So we have horizontal analysis and vertical analysis. And then we're going to get into financial ratios. That'll be a different learning objective. But so this one talks about what we're comparing. So we may compare the company to itself. So that we're saying, okay, if we look at last year to this year, did we improve? Did our sales go up? Is our gross profit margin better? So again, we're comparing ourselves to a past version of ourselves. We could compare ourselves to another company. So maybe we have a competitor that we're always, trying to beat, and we have access to their financial statements. We could look at them to say, okay, are their sales higher than ours? Do they have better control of their costs? What's their average collection period? And then there can be industry averages. So industry averages then will take, all the companies that operate within that industry and then form an average, and then we could compare it to that. So while that could be our benchmark to say we want to exceed industry averages. So then how we do that, though, is we perform horizontal analysis, vertical analysis, and ratio analysis. We'll focus on your test and on your homework. It's primarily the ratio analysis that I focus on, but you do want to understand all three of them. So horizontal analysis is a trend. So like I said, we're looking at ourselves, our financial statement data over a period of time. So again, whether it's going from year to year to year, or maybe from each quarter, but we're going to compare it to say, again, has there been an increase or a decrease? Have we gotten better or have we gotten worse? And again, internal management finds this horizontal or trend analysis very helpful because it can help them determine if they need to make changes to be more efficient. Marketing maybe needs to push to increase sales, or the collections department needs to get on the customers to get them paying on time. They can make changes in real time that can impact these statistics or these ratios. So here shows you a comparative balance sheet. So we're going from one year to the next year, and then we're looking at, did it increase or did it decrease? So in this example, it looks like they all increased, and then this gives you the percent that they increased. So then again, depending on what that is, those all could be good statistics, or maybe they're not. Like if it's debt that's increasing, maybe that could be a problem. But in this case, it looks like everything would be fine. Then we have our comparative income statements, again, one year to the next. And those two, it looks like all have increased except for our income tax expense. So again, that seems like that would probably be a good thing. It's possibly a relationship to what our net income is, or what the tax rates are, or whatever. But so sales have gone up, cost of goods sold have also gone up. Now this could be where you really kind of get into the nitty gritty to say, okay, well, look, sales went up 8%, which is great, but cost of goods sold went up more than that. So maybe that's not great. Do you know what I mean? Maybe that if we could have tried to bolster our sales so that it covered, more than the cost of goods sold increase, something like that could be things that the internal management would look at. Interest expense is up 9.2%. Maybe that is also not a good trend. Maybe we want to look at that and figure out, what's going on with our debt. Wouldn't it be great if we could keep that steady while our sales go up? So those would be things, again, the internal managers would be using these statements to decide. Vertical analysis, or a common size analysis, is what we do is, instead of looking at the dollars and cents, we convert everything to a percent. So on our income statement, everything is a percent of sales. And then on our balance sheet, everything is a percent of total assets. So here we have our balance sheet. So again, you can see the total assets are 100% because everything is going to be expressed as a percent of assets. And then if you understand how that works, as a percent of means I'm taking this line item, like current assets, and I'm dividing it by my total assets. And that would be my current assets as a percent of those total assets, which would be 23.8%. And my property, plant, and equipment, same thing. Total property, plant, and equipment divided by total assets gives me this percentage. Other assets are same deal. This total divided by our total gives us a percent. So then we can kind of see it. Then we can compare percentage wise, because sometimes dollars and cents aren't as telling. Because then you're like, okay, everything's up $200,000. Well, what does that really mean? Now you can look at it to say, okay, well, my current assets are really what has increased here. And then my other assets actually have decreased a little bit, right? No, sorry, increased a little bit. So then we can see that, again, but out of the total, this was a higher percentage of our total. As a percent of the total, the other assets have gone down. So it's just another way to look at it, and sometimes a more meaningful way to look at it. And then if you were to compare it to another company's common size statements, again, it takes away the size difference. So you could compare a large company to a small company because you're just looking at percentages. And then same with the income statement. Now everything is a percent of sales. So cost of goods sold, we take the $6,597, divide it by our sales of 11,776, and that gives us that 56%. So then we do that for every single line item. Selling administrative expenses divided by sales gives us that percent. Interest expense divided by sales gives us that percent. Do that all the way straight down the income statement. And then again, you can compare to say, okay, well, now that I'm looking at it, my cost of goods sold as a percent of sales has gone up. So that could be a problem. We would like that to stay constant. So if our cost of goods sold go up, we should probably up our sales price. If we don't, you can see it lowers our gross profit. Then maybe say with selling and administrative expenses, those have gone up as higher than as a percent of sales than they were the prior year. Why is that? Maybe that's another thing we want to try to keep constant. So we have to try to push our sales to cover that. And here we go in intercompany. So we're comparing one company to another. And again, like I said, you don't have to look at dollars and cents because you can see this company here is bigger. It's in millions. This company here is much smaller in thousands. But when we look at these percentages, we can actually compare them to say, well, hey, this company's doing better. Its cost of goods sold are a lower percent of sales than this company's. Now, but wait a minute, here selling administrative expenses are much higher as a percent of sales than this company. And there could be reasons for that, but it makes a more useful comparison than just looking at the dollars, and especially when it's millions versus thousands. Okay, so then we get into our ratio analysis, which again is something that you want to understand. You want to be able to compute these. We have liquidity ratios, solvency ratios, and profitability ratios, and we'll talk about each. So again, our liquidity ratios are measuring the company's ability to pay its short-term debts. So it's, do they have the current assets to pay off their current liabilities? So again, it's focused more on a current side, a short-term side. The solvency ratios are more the long-term side, the ability to survive over a longer period. Again, pay off their longer-term debt or have the income, being produced from that debt. And then the profitability all goes back to the income, net income compared to assets, net income to equity, the earnings per share, all of those kind of earnings type ratios. So here are the grouping of the liquidity ratios and the formulas. And you'll want to know these because you're going to have to compute them. So this might be a good one to print out or to have available to you. And again, if you look through these, we're going to pull these balances right off the balance sheet or the income statement. And here's our solvency ratios, again, with their formulas. So our debt to assets, our times interest earned, and our free cash flow. Again, these are all ones that you're going to be asked to compute. Then the profitability ratios, we have a lot more. So again, and they all kind of, if you look at them, they all kind of start with our net income or our net sales. So that's all kind of included in those because we're looking at our how we're producing money compared to our investments or our equity that our investors have invested in the company. And then this is our market price. Our price to earnings ratio looks at, well, what's our current share price compared to the earnings per share to see, again, the profitability that we're producing for our investors. So here we have an example of the ratio analysis with this Chicago cereal company. So again, we have their assets and their liabilities and owner's equity. We have their full balance sheet for 2 years, and their income statement also for 2 years, and their statement of cash flows for 2 years. They give us some additional information that these are our common shares outstanding, and this is our stock price at the end of both of those 2 years that are given. And then we're going to go through and actually compute each one of those ratios. So again, you'd want to know your formulas, but they'll give them to you here in this little table. But we're going to take the formula and you're going to go back to the balance sheet to find what are those current assets, divide that by the current liabilities, and that gives you your ratio. And then you do that for the 2 years that are given, as well as compare it to the competitor that we were looking at, and then the industry average. So then this way we have the where they're comparing within the company, the intra-company, the inter-company, and then that benchmark of that industry average. And then they'll go through in the PowerPoint and do each one. Now, again, as you're computing them, again, just look at the formula, tie that back to the income statement and the balance sheet, and then look at the analysis. So again, if there's anything that jumps out, like I feel like this company's better than the industry average, but they're not quite as good as their competitor that they are benchmarking against. Then come into the average collection period. Again, plug in your formula, figure it out. Again, they're very close to their competitor. They're a little better than their industry average. Inventory turnover is how often they're turning their inventory into sales. And they are doing it more times than their competitor, and they're better than the industry average also. The more often you turn over your inventory, the better. The days in inventory is how old your inventory is. And again, depends on, these are cereal companies. So, the shelf life of cereal is longer than, say, produce or meats or something like that. So in this case, it can be a little longer. But again, the shorter the days in inventory, the better. So then this company is doing good. Then our solvency ratios deal with more of that long-term ability to pay. So here we have our debt to assets ratios. Now this company is much more in debt than their competitor and their industry average. So that would be something to investigate. Why do they carry so much debt? And is that acceptable, or is that an area of concern? The times interest earned shows, well, can they finance their debt? Do they have the net income to pay their interest? And they do. The higher, the better. And obviously, the other company in the industry have a higher times interest earned because they had less debt. The free cash flow shows that, based on their money coming in from operating activities, they're able to pay their capital expenditures and their cash dividends, and how much money is left over. So that too would be the higher the better. Then we get into our profitability ratios, which are all of our different returns, dealing with our net income and our net sales. So those are going to go, again, to the income statement where we pick up our net income. If there are preferred dividends, we always subtract those out, but most of the problems will not have those. And then we're going to divide it by our stockholders' equity for our return on equity. And again, the higher the better on all of these. On all these profitability ratios, the higher the better. Then our return on assets is our net income over our total assets. And again, the higher the better. Profit margin is our net income divided by sales. And again, the higher the better on that one. And this company is better than their competitor in the industry. Asset turnover is how often we turn our assets, or how our assets are helping us generate our sales. So this is instead of our net income, it's our net sales divided by our total assets. And again, the higher the better. And it all depends on the industry, because if a company has brick and mortar buildings and equipment that they need to maintain, they're going to have a higher asset base and they may not be able to turn that over as often as, let's say, like the Dollar General that doesn't have that type of stuff. Okay, then we have our return on assets, which is then our net income over our average total assets. And again, the higher the better. Our gross profit rate is our gross profit, which is our sales minus our cost of goods sold over our sales. So it's how much profit is left to cover our operating expenses and eventually provide us profit. So again, the higher the better. So this company looks good. Earnings per share is our net income minus the preferred dividends, if you had any, divided by your weighted average shares outstanding. And again, the higher the better. If the company has less shares outstanding, that increases this earnings per share as well. So that could be, the difference even between some of the two companies. The price per earnings is your market price per share divided by your earnings per share. And the lower, this one has a lower, so it indicates that maybe investors are a little less optimistic about the company. It's kind of going back to say what would, how do the investors feel when investing in our stock? So the higher the better here. And they're significantly below industry average, so that may indicate that there is, an issue with their stock price. Okay, then our payout ratio is your cash dividends paid out over your net income. So what type of a percentage are you paying out to your shareholders? And then this, you can't necessarily say the higher the better. It's just the company's choice whether they're retaining their earnings for capital projects or they're paying out. So again, it depends on the company, on whether it'd be a high payout or a low payout and kind of what stage their business is in. So you really want to go through all of those ratios on your own time and kind of look how they're computed, and just understand those, because you will be expected to do that on your test.